Hello, I'm Rick Underwood, and this is David Walterman. We're with the Reverse Mortgage Group, and today's question is, can you use the equity in your home to pay off debt?
And the answer is yes. There are a few options, but if you are 62 or older, we think a reverse mortgage should be your number one consideration.
Yeah, for the right person, it is the best program.
Right.
And they're very easy to qualify for a reverse mortgage. The requirements are you need to be at least 62 years or older, you need to live in your home, and you need to have equity in your home.
And we consider it a bonus, but some of the concerns with conventional loans, like credit scores, income, are typically not barriers for a reverse mortgage. It's very easy entry.
Exactly, because you're not qualifying the person.
Right.
It's the home that's the security on the loan. So very easy.
So in this episode, we're going to walk through a real world example to see if the numbers work to, help this couple pay off debt.
So let's look at it. What's our scenario?
Let's say you're in your late 60s.
Okay, give me a number. 68.
68's a great number.
Okay.
So you've lived in your home for quite a while. You're sitting on considerable amount of equity. But along with a small mortgage balance, in this point in life, you've racked up some serious debt. You've paid for an expensive wedding. You've put a couple kids through school. And so in the course of doing that, you've maxed out a HELOC, a home equity line of credit, and you've maxed out your credit cards.
Yes, which is very typical right now, especially in LA, Orange County, where we are. I mean, the national average of savings, I want to say, is $20,000. That's it.
Yeah.
In savings. So baby boomers are spending.
So we'll put some numbers to this, but at this point they've already done the HELOC. So their only other option is a cash out refinance.
True.
Which is just going to add more payments each month.
True.
So a reverse mortgage, let's look at it.
Right. And with the cash out refinance, rates are considerably higher, and they can't get another HELOC because they already have one.
Right.
So their only options, you're right, would be a cash out refinance, which not with rates the way they are, and they'd have a payment. Reverse mortgage kind of seems like the best option for them.
So this couple are living in a home that's worth $1.825 million.
Wow.
And like we mentioned, they've got a HELOC, and it is tapped out at $80,000. And then those credit card balances total $45,000. And we're figuring the monthly payment just on those two alone is probably $5,000 or so.
Probably, yes. And it's revolving. I mean,
Right.
that interest is high.
Right.
Yes.
Yeah, they've experienced an increase in their interest rate on both their HELOC and their credit cards.
Yes.
So,
Yes.
And then they also have a small mortgage balance of about $120,000 left. So obviously their goal in this scenario is to pay off their debts, and they're going to learn that, they're going to wipe out their mortgage and the debts at the same time.
Right. Because once you add that mortgage payment, I mean, we're probably close to $9,000 a month.
So we know in a reverse mortgage, some of the key factors the bank are looking at are the age of the borrower and the value of the home and the county that the home is in because of lending limits in different counties. We've plugged these numbers in, the age of 68, the home value of 1.825, and the bank is giving them access to $386,702.
Can we illustrate this?
Yes, let's.
My favorite way to illustrate this is with a house. I think it makes
Draw a
logical
house.
sense. I think it's going to be the easiest way to demonstrate what we're looking at here, because so many people
They might
stop
want
us
to
right
use a
here,
different
they think-
contractor next time. This wall's
Okay. I'm a numbers guy. I'm not a builder. Okay, hold on. Okay, we're going to give you
the door.
and a very crooked window, but we have an idea. Okay, so let's say this is their home.
Okay.
Because we still got to get our head around what is a reverse mortgage, how does it work? You're not making a mortgage payment. How does this happen?
Wait, say that again because that's important.
You're not making a mortgage payment. That's the critical piece in this.
Magic.
Yes.
Okay,
Yes,
how does it
yes.
work? So their home value is 1.825.
Wow.
And like we mentioned, the bank is giving them access the principal limit is what it's called, of $386,702. 386,702.
Okay, now, once again, when we plug in their age, the zip code, the value of their home, the calculator is going to spit out a very specific number that is their principal limit. That is the maximum amount that the lender will allow them to borrow. However they slice it out.
Some people are already thinking, well, man, in a $1.8 million house, why they're only giving them access to $386,000? And the biggest factor in this is their age. They're still pretty young.
Exactly.
They're a young whippersnapper.
Exactly. And the amount they let you to borrow it's kind of like insurance actuaries in a way. The older you are, the more they're going to allow you to borrow because they aren't worried about leaving a whole bunch of equity in the home. So that being the case, you're right, that is relatively low. People, clients we work with in their 70s and 80s, it's $400,000 or $500,000.
But I can already tell they're going to meet their goal.
Yes.
Which is awesome. So explain how a reverse mortgage works then.
Okay, so with the reverse mortgage, let's say in their case, they're probably going to take all that out right when they fund. You don't necessarily need to with a reverse mortgage, but right when the loan closes, they're going to pay off their equity, their home equity line of credit. They're going to pay off their mortgage. They're going to pay off credit cards. And chances are they may even want to take out some of that cash and just put it in the bank and have it as reserves liquid for whatever they need. So let's assume they're going to take out all $386,000. If they do, how a reverse mortgage works is instead of making a mortgage payment, because they're not making a mortgage payment.
They're not making a mortgage payment.
Because they're not making a mortgage payment, every single month, the bank is going to assume a little bit of the equity in their home.
Right.
So that's how a reverse mortgage works. On a traditional mortgage, you're making a payment and it's lowering your mortgage balance. On a reverse mortgage, the lender is assuming a little bit of your equity. You're not making a mortgage payment.
But let's talk about the concern that some people have right now. Oh, no, my loan balance is growing.
Right.
They might forget that they're sitting in an appreciating asset. This home that is going to grow at an average, let's say, 4% a year.
Oh, my goodness. Yes.
So their home value is increasing over time.
Without a doubt. And we always talk about averages. So we're going to assume a appreciating average of maybe 4%, 4.5%.
Yeah.
So how quickly that appreciating asset on this.
Just to illustrate that point, in 5 years from today, their home is now going to be worth $2,220,000.
Wow. What was it again?
$2,220,392.
Wow.
So that's an important factor to consider, that your home is continuing, you still own your home, and it continues to appreciate over time. Let's get back to the numbers. So they had a $120,000 mortgage that's getting paid off. And then they had an $80,000 HELOC that's getting paid off, and about $45,000 of credit card debt. Now, here's the cool part.
Yes.
There's a little bit left over, and that is a line of credit. So the line of credit for them is $107,023.
Wow.
So this line of credit is not accessible for the first 12 months, right? But it does sit there and it grows over time and can be accessed for any reason.
Right.
Which is a wonderful safeguard for any homeowner to know that they just have access to cash.
Exactly. Especially for folks like this who they are spending. They are going to have expenses. I mean, who knows whatever else they may want to tap into. That they are not giving up that line of credit.
Right.
They just have a new line of credit. But the nice thing about this line of credit is it can't be frozen. They're not making a payment on it unless they draw anything from it. They're not taxed on it. So it's still a safety net for a lot of folks who still would like to have that line of credit.
So we just demonstrated how this couple, through a reverse mortgage, is eliminating probably close to $9,000 to $10,000 a month. Right. So my question to you is, what would you do with an extra $9,000 or $10,000 a month in cash flow at this age?
At a time where you do want to be living, you're retired, you're on fixed income, if anything, it's just, you want to be able to live, and $9,000-$10,000 a month. Now, another thing we should talk about, we didn't even discuss this whole space right here. This is all equity that remains in the home, and they own the home.
Belongs to the homeowner.
Yeah, so whenever they go to sell the home, they still have all that equity.
Right. Yeah. So we realize that debt could be a hot topic these days, especially with the inflation that's happening.
Right.
And we want you to know that we're here to answer any of your questions. We realize every scenario is going to be different.
Yep.
We'd love to hear from you. We'll plug in your numbers to see how they look for you and see if we can lift that burden of debt off of your shoulders.
Exactly. And we're happy to run numbers because it'll tell us exactly the amount that you can borrow and see if it works for you.
Thanks for tuning in. Be sure and like and subscribe, and we'll see you next time.